Good evening, one and all. My name is Misiewicz from Optimise Accountants, and good evening to you on this fine Monday, or shall I say rainy Monday. And pleased to say that I've got my headphones in today, so I'm a lot more clearer than I was probably last week when I was a little echoey, I noticed in the background. I have got a purpose-built microphone, but I'm on the cheap today, and this was a lot easier to install. So if you don't mind the kind of earring type headphones I've got on, let's proceed with tonight's session. As ever, the session will go through 3 different sections, but before we get into any of the details, I want to give you a big announcement. And the first one is I'm going to be doing a whole section on capital gains tax. This is all about how you might sell a property for whatever reason, and you'll end up having a capital gains tax. I want to show you some of the rates and some of the allowances you can get, but also some of the other things such as the ways to minimize your capital gains tax. So I'm going to go through that in a lot more detail later on. But before I do, I want to talk to you about our new property online course. This is great for any landlord or property investor, property developer that wants to understand property tax in a lot more detail. So we've developed a course that you can access today. I said it was going to be in the mix. It finally has launched today, so I'm pretty pleased about that. And what I thought I'd do just very quickly so you could talk about that, I'm going to share a different screen that allows me to go into a bit more detail. So I'm going to go into my Google Chrome, wherever that's gone. Here we go. So I'm going to go to Google Chrome. So what I'm going to share with you is, here it is. I'm going to give you the URL before, well, I should say after this session is finished. You can be able to go to the description field of this video and then download just take the link from the description, pop it up into your Google Chrome, Safari, or indeed if you're using Firefox. And the other one was obviously Microsoft Internet Explorer. Who uses that? So you can use the URL, which you can see just I've typed in there. I'm not going to try and read that out for you, but it is our course, all of understanding about tax as you see it. There's a lot of details, and there's a curriculum as well in there. This course is great for people who want to watch a few videos, snippet videos, normally about 5 to 10 minutes long maximum. There's also going to be in there some Q&A to help your understanding, and there'll be some articles that I've repurposed and I kind of put there into the sections as well. There'll be spreadsheets, and it will be updated on a monthly basis too. Now, as I said before, there is a big announcement, and I'm going to share that big announcement later. Yes, indeed. You'll notice that there's a code that's got 4 little question marks. In fact, let me just do a resume a new share here. And this question marks, this code is really important if you want this course for free. Yes, free. Since you're listening to me on YouTube, I'm giving all my subscribers this for free, or should I say only a handful. And I'm going to give 25 people in the month of September ability to get this course for free. It's £120 normally, but for the first 25 people that use the link, get into that platform, type in enrollment, you will get that for free. That's a price guarantee right there. So you'll see lots of materials being developed as we go through the next course of 12 months and so on. But the course is pretty much there where I want it to be. So feel free to get hold on to that. Okay, without further ado, let's go into what's in the news. An interesting read, as usual, to be fair, in the news this week. So let's talk about what's in the news. So let's just do a new share. I have to get used to these new screens that I've got going on here. So I'm going to go into Google. Here we go. So let's start with the first one, which is Hargreaves Lansdown. I haven't wow, just noticed I've got through a whole bottle of water. I haven't really done anything with Hargreaves Lansdowne in terms of reading their materials before, so this is a first. So hey, thumbs up to you guys. The interesting article is buy-to-let property market dead. Well, to be fair, it's pretty much an overused terminology now, isn't it? Is property market buy-to-let dead? I think I've written an article. I know lots of property investors, mortgage brokers have all read the written articles that had buy-to-let is dead in their article at some point in the past. But despite that, one thing I did read, and there was some tones of why it's negative now to be a property investor. I was like, oh no, not another one of these kind of real negative ones. It talks about the changes in legislation, which I'm going to zoom up there so you can see that yourself. Again, relatively negative, but you know, I was at this point I was getting quite depressed. About to reach out for the Prozac, and just before I get there, I thought, wow, okay, they just nipped in the bud and said, here's some positives out of it. And they talked about, you know, buy-to-let is the only way that you can use a mortgage to help yourself get a good return on your investment. I thought, by Lord, thank goodness for that. And it gives you a nice little example. So, you know, as much as it does talk about then kind of stock markets and stuff like that, it was a well-written article throughout this. So it's quite a negative towards property to begin with. It did snip it in with a positive. But if you want to have a look at that, a good article to be fair, but from Hargreaves Lansdowne, is the buy-to-let property market dead? Pros and cons on either side, worth a read. As ever, in the description field at the bottom of this video, I will be putting in the URL and some of the descriptions that I liked about the article as well. So you can read these later on at your leisure. Okay. The next article I liked was Residential Landlord. You can see the URL there. And they started their title with landlord commitment to buy-to-let investment property market. And if you've read organizations like NLA, RLA, the newspaper press and so on like that, you would have seen that, do you know, I'm struggling here because I've had some couscous, and a piece of couscous must be lodged inside of my esophagus somewhere, and it now is making me really choke. So I'm hoping it's going to go away at a point in time. So if you see me red, faint, please do call the doctors. I might be in some serious danger. Piece of couscous, nevertheless. Joking aside, just before anyone does start worrying, landlord commitment to buy-to-let investment property market, and most articles that I've read have been negative. People are selling out. 80% of these people are going to jump off cliffs and like the lemmings and throw away their keys and give it to the mortgage brokers. And it was quite an interesting, and I always find that statistics, try and say that when you've had a glass of wine. But this says the commitment shown in report confirms that 84% of landlords are looking to maintain or increase the number of properties. Now, hang about, because RLA and NLA are saying different percentages, but they're all willing to give up their properties for free. And this kind of says everything other than that. So I think for me is just don't read the media. If you believe in Donald Trump, then he will always say that the media is made up anyway, especially if you're from CNN. And that's, by the way, before I get sued for that kind of thing, that's his comment, not mine. So go onto his Twitter profile and you criticize him. But my viewpoint on this whole thing is just look at what you want to do. Don't get too bogged down with what they say, what he says, what they're doing. Should I be following suit? Don't be a lemming. Understand what you want from your property investment, and you make those decisions for yourself. Just because it doesn't work for someone, it doesn't mean it's not going to work for you. And Warren Buffett, again, this is an overly used quote for my liking, but Warren Buffett said once, if people grow fearful, then you need to be greedy. When people are greedy, you should grow fearful. And that's a nice kind of thought process, is not following the norm, go your own journey. But equally, make sure you don't go your own journey completely lonely and isolated and then make a hash of it. Make sure you do get some good specialist advice. And I'll come back onto that point of specialist advice later on, actually. The next one was talk about investors should pay more tax, says leading think tank. Oh, really? I mean, we should just pay more tax. I'd love to know who wrote this article, actually. It's the first time that I've read something from This Is Money. And I just thought, well, you know, not the person who wrote the article, but the people that they must have spoke to, this think tank. People must pay more tax if you're a property investor. And this article, which, you know, it's a long title, I'm sure you can appreciate from This Is Money, but it talked about that the investors such as yourself and me should pay more tax. And this is here. So under the just tax plans published by the Institute of Public Policy Research today. I don't know who these guys are, and quite frankly don't care. But equally, when they're saying people must pay between 10% and 20% of the basic rate taxpayer, and for high rate taxpayers should pay 40% to 45% potentially on their CGTs, even though on their own homes, they're saying. I mean, you know, how far do they really want to push the tax burden onto just not investors anymore, homeowners? So it just kind of makes me wonder what is going on. And it's basically if Labour get in. So if I was you, I would take your Labour voting card, rip it up into 1,000 pieces and throw it at Corbyn. No. Let's not incite violence. Just throw your stuff and then carefully and gently put it in the recycling bin. Okay, so that's what I should have said, not the other bit. But ultimately, you've got to think about who you're voting for. If you're going to be voting for Corbyn, you can kiss goodbye all of your property investments and returns, because they're not going to be there much longer. So I'll let you decide on that. And my dear good wife, Louise, is a Labour voter. Interesting conversations we have. So here's another article, being a bit more positive. Eastern Daily Press Property, something I don't read that often. I've not seen it on here much. But again, a very, very interesting article. Talks about what to consider when investing in a buy-to-let property. This is from Nick Ely. Very good article. I love the fact that they put the date and the time that they published it as well. That's fantastic, isn't it? So 9/21. Nick, great article writing. Nick talks about from Watson's letting agent, I think this is. And what thing I wanted to do was, there's a couple of videos in here which I thought was pretty decent. But the snippet, and there's quite a lot of information in here, but it does talk, and I'm not sure why I've taken it off here. But the focus is very much on rental yield and capital growth as well, which you'll see in the description box below. But again, it was just a nice overview of what property investments are. And if you're thinking of getting into property but not sure, you know, have I thought about everything, then this article is quite good. If you want a review of your portfolio and say, well, am I going the right direction? Sometimes reading someone else's articles to give you that reflection is a very good way of doing that. So do feel free to look at the Eastern Daily Press Property, that is, what to consider when investing in buy-to-let property. And like I say, it was published at 9/21 on the 6th of September. So have a read of that, but a very good article indeed. Another one was landlords voice their views on future buy-to-let. Now, where do we go with this? Because every article I've read before, it's doom and gloom. Everyone should run and panic. Lemmings jump over cliffs, sell everything for nothing. And then the other side, the more sensible side, is saying, well, actually, those that are professional buy-to-let property investors, they will stay for the duration and they will find ways of making things work. And I think that's true of any situation, to be fair. But this article talks about, again, the use of limited companies. It's looking at the increase of SDLT, which we did an episode of this specialist area last week, which you can revisit that, or you can wait till Thursday, in which I'm going to be doing a whole video suite talking about SDLT, so feel free to look at that. It does talk about personal taxation, increased legislation, and landlords' concerns. However, the one thing I did pick up was with regard to financial side of buy-to-let, only 15% of landlords seek specialist tax advice. 15%. That's amazingly low. And whether they just are burying their heads or just think we don't need advice, we can just use some piece of software to do that. I'm stunned by that number, if that's true. And 42% who obtain a mortgage to purchase their poor choice their property, I should say. They are only 40% using mortgage brokers. Again, I find that astonishing, that people do not use specialists. And I think sometimes people are penny pinching. They don't want to use specialists because they think, well, why should I do it? I can surely go on Facebook and Google and find out all the information I know. These guys, whether it's as tax specialists or someone else, or lawyers, solicitors, or architects, these guys are going through their exams. They've got 10, 20 years of experience. Of course, they're not worth investing into. What do they know? Come on, guys. I mean, you know, that's a sure way of paying too much tax, paying too much mortgage interest costs, building something that doesn't work. You know, you've got to use a specialist advisor across the board. This is where you become, I would say, a professional business owner or an amateurish landlord. And it'll probably be the amateur landlords who don't get that advice will be the ones who are taxed to the hilt and then give up and complain about the country. If you get specialist tax advice, mortgage advice, architectural advice, they will tell you things to avoid all these issues that you're finding in the press, and you will be more successful. So it's up to you whether you want to invest in yourself or not. That's really going to be up to you to do. So that's pretty much me to a close on today's session of It's in the News. I've got a whole section on capital gains tax I want to share with you tonight. So I'm pretty pleased with that. If you have any questions, comments, views, even comments about my earrings, then feel free to drop that into the comments box below this video or to the left of the video, whichever device you're using. And I will make sure that I get back to you at the end of the session as we go into this section 3. So what I'm going to do now is go over to my PowerPoint, which says we're over to tax focus. So the tax focus very much will look at all types of tax that you might have, whether that's SDLT, VAT, profit tax, CGT, and the different types of properties that you might have. So that'd be single lets, HMOs, holiday lets, and flips. And this section, funny enough, will be used in part to populate the Teachable's platform of buy-to-let property tax, which we have created our own course, as I mentioned in the beginning. So part of this will be in there, but let's run through tonight about CGT, because I thought that was an interesting one to go through. And I'm just going to change my screen so I can do this relatively easily. Okay, that's fine. So I'm going to just open up now my CGT. This is really insightful information tonight, guys. So hopefully this is going to be useful for you. I'm just going to share my screen now. Okay, here we go. Here we go. So here we are, capital gains tax. So capital gains tax is when you sell a property. There are some changes to CGT, and I'm going to be announcing that next week. So this week, I'm going to be focusing on CGT in the main, but I'm going to be discussing CGT, different allowances, and changes to those allowances next week. Those changes will come into play in April 2020. So you need to be aware of them, but not so pressing that I need to do it tonight. I really want to spend some more time on this. So if you do have any questions, then make sure you type those into the question box. And by the way, guys, if you've liked this so far tonight, why not give me a thumbs up, just to say, thanks for the time, thanks for the information, this bit's been useful. Just give me a thumbs up if you've really liked some of these aspects, and drop a comments box. That's always useful. If you haven't subscribed to this channel, make sure you do so you get notified of any new video that we're going to launch as well. So let's talk about what's tonight. We're going to focus on capital gains tax, annual allowances and rates, then how a gain is calculated and how CGT may be reduced. And as it's highlighted in yellow there, we are going to focus on the annual allowances and the CGT rates that may be deployed against you. Notice the word against, when you sell a property. So the first thing I would like to say, just to bring to your attention more than anything else, is that everyone can make a £12,000 capital gains tax, capital gain, and not be taxed on it. So every individual can get that. So we'll talk through an example like that. So that's the CGT annual allowance. So £12,000 gain will not be taxed at all. Basic rate taxpayer, you'll notice that we've got two different levels now. The government have penalized property investors yet again. So basic rate taxpayers will have a 10% CGT tax for non-property items and 18% for property. And high rate taxpayers will have 20% for non-property stuff, and then 28% on property stuff. So that's the kind of rates that you need to be aware of. And what I'm going to do, like I say, if you've got any questions, make sure you do type those into the comments box. I will answer those typically within 36 hours, if not sooner. So I'm going to use the CGT allowances and rates, the £12,000, which everyone gets, plus the tax rates of 18% and 28% for buy-to-let property investors, which is what this course is all about anyway. Now we're going to go through how a tax is calculated. And what I've done, I've given as an example, which we're going to follow through all the way through this next 20 minutes or so. And what you'll notice is that we've got a house price that's been sold for £200,000. We are going to ignore things like sale, estate agent fees. We're just going to count that as towards the net sales price, if you like. And we've got the less purchase price, including SDLT of £150,000. And they did some refurb costs as well, which were capital in nature, whether it's an extension or something like that. This person made a £10,000 gain. Do you think this person will be paying any tax? Well, if you listen to what I've just said only 2 minutes ago, and you're not my son Hugo, then you would realize that you will not have to pay any capital gains tax at all. So we've got two examples here. We've got John, who's a basic rate taxpayer, and Christy, she is a higher rate taxpayer. And both of those have made a gain of £10,000 in this example. And you've got less your CGT annual allowance, which is £10,000. How much tax? That's right, none. So you can make these gains on a property or any other type of asset, in fact, and because it's below the £12,000, you will not have to pay any capital gains tax at all. Now, I would always disclose that information on your tax return. So even if you're not making a capital gains tax, I would always disclose it, because if HMRC ever do an investigation and see that there's been a disposal, but you've not put it in your tax return, it really unravels conversation you don't want to have. So my advice is always put it on your tax return, even if there are no gains and no tax to be paid. Following suit though, let's imagine that the same example, but the refurbishment was less. You can see here that the example now has a £30,000 tax. Should they be paying tax on this £30,000? By the way, this is not a political question. This is just a mathematical question. So the gain of £30,000, let's imagine now we've got, again, John and Christy, both £30,000. They get £12,000 CGT annual allowances, if you remember from the previous slide. And therefore, they've got capital gains tax of, a taxable gain of £18,000. You'll notice that John has got an 18% tax bill And Christie's got 28% tax bill of 5040 versus John with 3240. So ultimately, there are high rates of tax for Paul Christie because she's a high rate taxpayer. Okay, so that is kind of how CGT, and pretty quickly a bit of a tour there, but we're going to go into the more pressing point of, well, how may CGT be reduced? I didn't want to spend too much time on the rates, boring, but we should be focusing our attention on how you make the reductions. There are 4 aspects we're going to be looking at tonight. The first one is use a deed of trust to transfer a property. What does that really mean? Who knows? Well, I should actually. I'm doing the webinar. The next one is phase disposal over a number of years. Sell loss-making properties is the third one, and finally make EIS investments. Each one of those can help you to pay the least amount of CGT. But the people that have done, the 18% or whatever percentage it was of those that are getting specialist tax advice, I bet the rest of the 72%, that's right, Mass, are not getting the special advice. How on earth are they minimizing their tax bill on selling their property? Unless, indeed, they're not making any money at all. They are probably paying too much tax, is the answer to that. So this is where I'm talking about the same couple here. So let's imagine that you've got John, John and Christy are now married. I met at a bar or something, and they got married, and they got this asset, and they're saying, well, we've got these gains. What do we do with it? Well, it could be that if we take either John has got the gain or Christy's got the gain, what do we do about it? Well, the answer is we can use a deed of trust. What is a deed of trust? Well, there's 2 documents you need to be aware of. The deed of trust basically says that this person owns the property, and we're going to move the allocation over to this side. Now, if we're going to do that, basically it could be that the property is owned 50-50 and you're going to change the share ownership, or one person can have 100% of the property and you're going to be moving a percentage of that property over to the other person. Ideally, the basic rate taxpayer, or indeed someone who's not paying tax at all, right? Now, 2 things, well, just one important thing before we delve into the main subject here. If you're moving a property, you've got the property that's owned 50-50, you would have got a joint mortgage. So that's no problem at all. If, however, you have got a property that's owned by Christy and nothing to do with John, then Christy might want to move that property over to John, but her mortgage terms and conditions says you can't do that unless you transfer the mortgage entitlement and debt ownership over to John. Why is that an issue? SDLT. So the amount of mortgage that's going to be transferred over, let's say the mortgage £100,000 in her name, you would technically be moving £50,000 of that mortgage to John, and it's above the £40,000, and therefore 3% SDLT charge will ensue. So you want to be making sure that you speak to your mortgage broker before you do this to ensure that you don't have an SDLT charge. You want to say to the mortgage company, lender, I'm going to be doing this transfer of ownership, but I want the debt to stay with me, okay? That way, we have no movements of debt and therefore no SDLT charge, okay? Good. Okay, so back to the point. If you've got a deed of trust, you could have a deed of trust legal document and a Form 17. A deed of trust document allows you to move the property between one person and another from a legal perspective. So I bequeath my 50% share over to John. John now gets all the property income and indeed the capital gains. Why is that useful? We'll come on to that later on. Now, if you've got a property that is 50-50 owned, then you are going to have to also tell HMRC that the property is no longer joint owned. You're going to have an interest in the property, but not necessarily 50-50. So you're going to have to take the deed of trust, which is the legal document, which says it's 50-50 previously, and now it's going to be a different percentage. And you'll need a Form 17 over the top of that, which then both copies needs to be sent to HMRC within 60 days. 60 days, by the way. So that's one thing that you need to think about when creating a deed of trust. Now, do you need to do a Form 17 altogether? Well, not always. Remember, a deed of trust and Form 17 is only used where you got a property that is 50-50 owned. But what if Christy over here has 100% of the property and she wants to transfer some over to John? Do you need a Form 17? The answer is no. No. You do not need a Form 17 if you're transferring the property ownership over from Christy to John. Now, this could be anyone, right? It doesn't need to be just Chris and John here. But it could be you own the property 100% in your name, and you're going to be transferring an element over to your spouse or civil partner. You don't need a Form 17. You do not need to tell HMRC in this regard. You just need the deed of trust, which is the legal document and is signed. That's the important bit. Okay, so now I've kind of covered off that in great detail, I've noticed. What can happen is that, let's imagine that Christy had the gain of £30,000. We know she had the CGT annual allowance. She's got taxable gain of 18,000. She had a tax bill of 5,040. Now, what we could do is say, well, Christy is going to give up her property ownership in full and give that over to John. Now, John, in this position, would then have the £30,000 gain, and he's got a tax bill of 3,240. Now, that's less than what Christy would have had to pay. That's brilliant. The people that the 18% or whatever it was on that survey who does get that tax advice may got this tax advice here, but it's not the right tax advice. And why is that? Well, what should have happened is that £30,000 gain, you should have worked out the percentage. We have spreadsheets on this kind of thing, whereby you say, well, okay, what's your income? What's the income of Christy, let's say? What's the income of John? What annual allowances do they have? Where can we push it to the high rate tax band? And we will calculate the specific by the 1% of the ownership of this property and who should own what. So in this regard, you'll notice that Christy will keep £12,000 of the gain, so enough of that percentage of the property, so 12/8/30. And she'll have annual allowances of £12,000, which means she'll have no tax at all to pay. John has less of the transfer of the 30,000 to 18,000 now, and has a CGT annual allowance of £12,000. I've just noticed I screwed up on the numbers there. That's £8,000, but nevertheless, the tax bill is just £1,080. So ignore the £18,000. That's a screw up on my part, but the £1,000 tax is indeed correct. So you are changing the tax position from 3,240, well, the originally was 5,040 by Christy having the property in her name, down to 3,240 by transferring all over to John, and then it's lessened even further by being really specific about the amount of money that's the percentage of ownership of the property, and now we're down to £1,000. So £4,000. How much did that cost you? Well, £300 for a deed of trust, maybe £200 for a tax advice, £500 in total. Not bad. So again, if you've got any questions, then please feel free to drop that in the comments box below. If you like that information, give me a thumbs up. That's always nice to get a like, and ensure that you subscribe to this channel. Let's move on to the next aspect of how you might save yourself some tax. Well, instead of selling all your property because of doomsday and the Labour Party ever getting to election, you want to decide to sell your properties, and that's fine. But what I would say for you is make sure that you sell your properties over a period of time. My mouth is getting cotton mouth. There's a pub in Nottingham called Cottonmouth. It's a great place, by the way. I have no idea why I've just come up with that, but hey, YouTube violation, probably talking about beer. So yes, so let's talk about property disposals over a period of time. So you could have a situation like this where you've got house one, house two. Amazing how those numbers are the same. It's just incredible. You know, roulette time in terms of the probability of that ever happening. But anyway, let's think about if this person had two properties to sell. sold it in the one tax year, you've got now a £20,000 tax bill, sorry, a £20,000 gain. And as we said before, you got £20,000 gain less the annual CGT allowance, and you got the correct number here of the taxable gain of £8,000 to have. Now, in this tax year, they'll have 1440 tax to pay on that situation. So now there could be capital gains tax allowances and stuff like that. But what I wouldn't want to bring to your attention is that this person's now got a tax bill to pay as a direct result of selling two properties in the same year. Not a good idea, especially when you can sell one property in March and one property in April. Technically, it's in the same calendar year, just in different fiscal years. Bearing in mind that the tax year runs typically from the 6th of April to the 5th of April the following year. So if you think about it, you could phase your properties over in March and then maybe April, May, the following fiscal year. Why should that matter? Well, you get your CGT and your allowances, don't you? So the £20,000 gain, if sold in the same tax year, would get a tax bill. But in this regard, if you dispose of one property in March and one property in April, then you've got the £10,000 gain and no tax to pay because it'd be swallowed up by your CGT annual allowance. So it's all about planning, really, as much as anything else. Don't forget, if you've got any questions, make sure you fire those questions in the comments box below, and I will make sure that I answer those as soon as I can. The next example here is loss-making assets. So you could have a taxable gain and tax losses. Let's imagine here that you've got a scenario of two properties again. And in this regard, you've got one property on the left, which is going to give you a gain of £20,000. Unfortunately, the second property you are looking to dispose of has a loss of £10,000. That would be useful to sell in the same tax year because the gain would not be £20,000, which would mean you would suffer you would have a taxable gain tax, obviously. But because of the house two, which is making a loss of £10,000, it means that the overall gain is £10,000. And so you'll have an annual CGT allowance of £10,000, which technically means you'll have no tax to pay at all. So it's always worth having a look at when should you sell a property, whose ownership it should be into the property. Should be my name or should be my spouse's name or my civil partner. Should we get some properties that is not making any money anyway and sell those coupled with ones that we are making money on? So we pay the minimal amount of tax. It's really up to you how you do it, but it is all about time planning to get the right amount of tax efficiencies. And the final thing is EIS investments. So you might have a taxable gain and you invest all of the gain into an EIS. Please note this disclaimer. This is only for educational purposes only. I am not, I repeat, I am not a financial advisor, a wealth manager, okay? I am here from a tax perspective of things you can do. But as I would always say in this regard, it's always good to speak with a mortgage. Here we go. So you should speak to 3 types of people whenever you're doing some type of investment. You should speak to a tax advisor. Sure, that's us, right? No doubts about that one. Unless you're the 72% of people that don't get tax advice, apparently. Also, there's the mortgage broker on the right-hand side. I would slash that with wealth manager as well. Some wealth managers do have mortgage brokers in there, but maybe speak to a wealth manager as well as a mortgage broker. And then finally, a solicitor down on the bottom left-hand corner. Their bubble has disappeared. Don't know if you've noticed that. I have. Oh dear. So ultimately, what I would say is that you should be speaking to different types of people whenever you make investments, and especially EIS. Always speak with a wealth manager, IFA. There is an EIS criteria I do need to take you through, which you would need to get some specialist advice on, by the way, on this subject. So the first one, EIS, the amount of money you put into an EIS, the company you invest into must be an unquoted trading company. So it can have nothing to do with property at all. It needs to be a trading company. It can't be a buy-to-let holding investment or whatever else like that. It has to be a bona fide trading company. Its assets must be less than 15 million. So we're not talking about a big size company here at all. And the people working in the company must be less than 250 people or employees. You can have no connection to the business of the EIS to get the release I'm going to be talking to you about, by the way. So there are some additional reliefs, such as income tax relief. So in this regard, we can't have any connection. Now, you can have connection to a company if you want just a CGT annual CGT release. But because I want to focus on different types of tax release, I'm going to say no connection for now. And you must own the EIS for 3+ years to ensure that you keep the tax release that you get by your investments. But like I said, I am not a wealth manager. I am not an IFA. Make sure you get special advice when you're talking about these types of investments. So let's go through an example here then. So here we've got, again, £40,000 capital gain being made on a disposal of a property investment. And what you can do is you take that £40,000 less the CGT annual allowance, which gives you £28,000. Now, you'll notice I've got no tax in both, and that is because you are going to invest that money into this. Oh, sorry, slide reverse here. So if you didn't make an investment, you would pay as a high rate taxpayer £7,840. But if you invest into an EIS, that becomes zero. So if you invest that full £28,000 into an EIS, you will have no tax to pay, no tax at all. As long as you invest the full £28,000 into an EIS, you will get tax deferral. Now, there will be people on here that talk about CGT deferral. There will be people that talk about, well, that deferral is over a period of time and it's only defer, it's not permanent. Well, actually, it can be. As long as you do the right tax planning with that EIS investment, it can be permanent in terms of the CGT deferral. So here we are. So we've got that EIS investment going on at £28,000. And what would be even more important here is if you've invested £28,000 and you, as Christy, a high rate taxpayer, paid PAYE on their employment or other types of income tax, then she can claim back £11,200, which is technically 40% of that investment. Now, that is provided that she has paid that amount of tax. Now, you can go forwards, you can go backwards. So ultimately, you should be able to claim back PAYE, especially on your EIS investment. Again, I will edge caution because EIS investments are a risky investment. They can go up, they can go down, just like anything else in this life. So make sure you get special advice, please. Don't go on the back of tax and just go, hey, I'm going to be investing in EIS. That's not sensible. What is sensible is saying, thanks very much for the tax advice. I'm now going to get my own wealth manager IFA to give me their insights to what I've talked about tonight, do some due diligence of my own, and then make an informed decision. Please make sure you do that. I beg of you. So again, if you've got any tax questions, then make sure you type that into the question box below, and I will make sure I answer those as much as possible. Again, if you're a client of ours, then make sure that you book a tax call with us to get those answers. And that's pretty much what I'm going to be talking about today on CGT. Next week, I will go into a bit more detail about capital gains tax and the changes that's coming ahead, and other reliefs such as lettings relief and private residency relief when you own a property, basically. God, what's going on? So when you live in a property, you do get PRR. Okay, that saves my bacon there. So PRR is a way to save yourself some tax, and I will talk about that next week, and some of the tax changes that's coming up first that you need to be aware of. All right, so I made a bit of a sham of that. That's fine. I can live with myself on this. So again, if you found that useful, make sure you give me a thumbs up, guys. That's really going to be appreciated. And what I'm going to do now is just stop my share altogether. And so you can see me, and I can then, oops. Oh, it said no share. That's perfect. That's okay. I'm back on screen. So I'm going to just see if you've got any questions. But like I said, give me a thumbs up. Please subscribe to this channel. That'd be really useful. And make sure that you do go on to the thing. Oh, I did say big announcement. Here it is. This is a bit of a drum roll, but it's actually breaking my laptop, so I shall stop that right now. So let's talk about the big announcement that I wanted to make to you tonight. So I'm just going to open up my new presentation, and then we'll go and talk to you about the new announcement. Okay, so let's just go. For whatever reason, I can't get this thing to work. This is awful. Right, here we go. Here we go. So what I want to talk to you is YouTube Live. I'll go into that in a second. However, the property tax workshop, the online tax workshop, this is where you can get information about how to save tax on Section 24, allowable costs, which way should you put your costs. Should it be income category or should it be a capital category? I'll talk about those things all online. There's a couple of spreadsheets that you can also download. Make sure that you use the code Optimise Free, all one word, Optimise Free, and then in the URL below this video, when I process this, by the way, it might be another hour before I get that, but if you use code Optimise Free, you will get this workshop for free. But, and here's the kicker, only the first 25 people, ladies and gentlemen, will get this for September. So if you are going to be here for September, then use that code Optimise Free, and then you will, if you're one of the first 25 people, you will get this whole course for free instead of having to pay £120. So can't say fairer than that. I did say I wanted to do this big announcement for when we get to 1,000 subscribers, but this course is a way for me to say thank you for those 1,000 subscriptions and for following us for as much as you have done. Hopefully you found this session being useful tonight, but don't forget that the Property Tax Workshop will also, the Property Tax Live YouTube will be here again next Monday between 7 p.m. and 8 p.m. So if you do have any questions, make sure you feel free to type those in. I am going to go back though, because obviously there was someone did ask a question, and I don't want to be ignorant and not look at that question. So the first question was, yes, please. So Chrome 1 said, yes, please. I'm hoping you're talking about the course. That will be with you in the next few moments as we go through that. The question though is, does the capital gains tax examples apply in a limited company? No, a limited company does not get a capital gains tax annual allowance, and corporation tax on these gains is normal corporation tax. So right now, you will be taxed at 19% for any profits made on disposal of an asset within a limited company. So the CGT rates is what I call income tax rates, and this really regards to individual people. All right, guys. Well, that's pretty much it. So please make sure you give me a thumbs up tonight. I really do want those thumbs up because it shares with everyone else that this has been useful. But until then, thank you ever so much. Have a fantastic week, and it's been a real pleasure tonight. So I shall look forward to next on Thursday. Don't forget the new video, which is all about stamp duty land tax. That's our featured video for this week, and on next Monday, I'll be talking about CGT again, as well as the property news section, and I'll cover off the YouTube live questions as well. There aren't that many questions tonight, so I shall see you guys again soon. Thank you. Good night.